Okay, so good morning, everyone. Welcome to today's macro snapshot. We are Thursday, February the 6th, 2025, about 7:30 in the morning as I'm recording this. Okay, so a couple of things I think were pretty important yesterday. We did get we had an interview with Scott Bessent, who's the head of the Treasury. And that was interesting because he made a couple of quite interesting comments. And also we had the quarterly refunding announcement, which of course is under the purview of the Treasury. So first of all, in the quarterly refunding announcement, the market took that as fairly benign news, sort of quite dovish news, because they agreed, well, the forward guidance said to maintain the current level of coupon issuance for the next several quarters, So the market took that as assuming that means, until maybe the end of 2025, beginning of 2026, the number of longer term bonds to be issued, so the 10-year and especially the 30-year, would remain more or less constant, that the auction sizes for those would remain more or less constant, and that any sort of funding needs or gaps by the US government would be filled by extra issuance at the front end in terms of bills and that kind of, and money market instruments, that kind of thing. So the point is that the bond market really quite liked that and sort of heaved a sigh of relief. So what we got actually, if we look at the 30-year yield, look at the 30-year or maybe even the 10-year yield, but if we look at the 10-year yield, we saw a pretty big fall yesterday in the 10-year yields. You see we're now down to about 4.4 to 4.4, something like that. And it's also broken this uptrend line. You guys will notice here there's pretty big trend line, which I will put there in the gray. You see here, let me just actually improve that, make that a more elegant and accurate trend line. So what you can see, that's quite a big deal because there was sort of a head and shoulders kind of situation here, and that fell down. So at this point, you've got to say that there's potential, at least from a technical standpoint, for a little bit more of a fall. We have quite an important level here coming up. There's also the 100-day EMA and the 200-day EMA, these orange lines. So it's possible, just from a technical level, that the 10-year yield might fall to, let's call it, 4.37, 4.35, something like that. And then the similar kind of situation, if we look at the 30-year, we can see that also, don't know if it's broken the trend line. Let's have a quick look here. That's actually getting quite interesting because it hasn't quite broken the trend line. And there's the 100-day moving average EMA there at 4.59. Let's call it 4.6. So that's a pretty key level here. And I think that's also a little bit of a horizontal support. You can also see that was also a little bit of a head and shoulders here. So I think around about here, maybe another few basis points on the 30-year, we could actually then get some stabilization, or indeed we could actually get that yield going up a little bit more. But the point there is that the market quite liked that underpinned equities a little bit. Also, just on the back of that, or co-joined with that, I mean, let's just have a quick look at the relationship here between crude oil. I think I've got a chart here, crude oil and break-evens. So you see here that what we've got here is the crude oil in black, and we've got the US 5-year break-even. So that, or actually the 5-year index. So it basically means where the market thinks the 5-year yield will be in 5 years. So it's kind of like the forward-looking outlook for inflation. And that's in yellow. And you can see here that they're very, very highly correlated. So pretty simply that if we get crude oil prices going down, inflation expectations go down, and often that puts downward pressure on yields as well. And if you want to just do a quick experiment, you can just simply overlay the 30-year yield with, or the 10-year yield with the crude oil price, and you see they're very highly correlated. So all that to say that oil came down yesterday as well. So where are we? Just put on my oil. So this is CL1 contract. You see here oil also having a pretty big down day yesterday. So that also helped with the quarterly refunding announcement, and also the fact that oil was coming down. That put a lot of downward pressure on yields, which of course is going to be supportive of assets. And we saw gold ripping and whatnot. But just talking about oil before we get back to the bond market here, this is broken down below. If we look here, let's say at the longer term fib here in the purple box here, you see that in this downward channel here, it did try to break out, and on the Iran possibility of Iran sanctions, it did break out, but it's fallen down again, broken down pretty decisively. It's now at some kind of sort of resistance level here. Oil, this is a weak market, and at this point, you've got to say what's going to sort of save this market, so to speak. And it seems to me that Trump's trying to drill more, and that the oil market globally is sort of pretty well balanced. So I think this market here, uh, I don't know, it's just sort of stuck in the mud here. But as long as the point I'm trying to make here is that as long as that stays low, inflation expectations should keep anchored, and they should also keep, all things considered, sort of long-term yields relatively anchored as well. But just getting back to Scott Bessent, and we'll just bring it back now to the yields here. So we'll put it on, let's say, the 30-year yield. It was interesting because in his interview, Scott Bessent said that he and Trump are not really targeting the Fed funds rate. So they're not going to telephone the Fed and say you have to cut rates. And what they're basically saying here is that they're much more focused on the 10-year and even the 30-year yield. And that makes sense because really the global benchmark and the US benchmark for a lot of consumer rates and mortgages and whatnot, as we all know, is the 10 and the 30-year. And so it's interesting that the first shot was fired to try and keep that lower. And I just wonder whether Scott Bessent and Trump, they really sort of thought very hard about the QRA yesterday. And so we have the QRA not issuing more coupons. So that's going to put negative, that's one factor to put negative pressure on the long-term yields. But the real question now is that Scott Bessent really said that it's very, very essential to roll over, to continue with these tax cuts, which Trump had from a few years ago and which are going to expire at the end of this year. And Trump and Bessent really say that's the cornerstone of their policy. They absolutely want to keep the tax cuts going. But if that's the case, the problem is that the tax cuts, it means less income, and less income for the government potentially means more issuance, more bond issuance to raise money. So something has to give. Either we have to raise taxes in the US, or if the tax cuts remain, one would assume that the Treasury has to raise more issuance, which of course is going to put a lot of pressure upwards on the yields, which is against what Scott Bessent's saying. So the only sort of third part of that triangle is to reduce spending. And obviously we're seeing at the moment that DOGE, the Trump, the Department of what's it called, Government Efficiency, that's trying to cut spending. We'll see. I mean, the jury is out. We'll see. But if definitely in order to keep the yields low and to keep tax cuts, there has to be a pretty massive across the board cut in government spending. Or on the other hand, more income. So again, this is where it comes into the tariff thing that Scott Bessent saying, well, the government can make a little bit more income from tariffs. And he's also saying that the point of the tariffs is, yes, to put pressure on trading partners, yes, to maybe raise a little bit of income in the form of sort of tariff taxes. But really what Scott Bessent said yesterday is that the goal of the tariff, the medium-term goal, is to actually force manufacturers or to encourage manufacturers to come back to the US, to onshore. And basically what he's trying to say is to rebuild the manufacturing base. And his theory and Trump's theory is that with a stronger manufacturing base and more factories and more production, physical production in the US, that would actually provide more tax income from all those products being made and sold. So there's a lot of ifs there, a lot of moving parts. But it does seem as though Bessent does have some kind of grand plan, which is, to lower prices and inflation through having more energy available. The famous 3 million barrels more per day of oil production. He wants to onshore production. He thinks that's going to create a more dynamic manufacturing sector through using tariffs. So the point I'm trying to make, I'm not sure that, in a certain sense, that Trump and Bessent love tariffs per se for themselves. It really seems to be part of a plan to, really to try and encourage as much as possible companies to come back to the US for their manufacturing. That's going to be difficult with a very high US dollar as well. A very, very high US dollar is also going to make those exports extremely uncompetitive and expensive. So a lot of moving parts, but the point is that the bond market quite liked it yesterday. And I think where we're at in policy, in monetary policy, is that the Fed will be left. Trump will no doubt snipe at them a little bit, but the Fed will be left in relative peace, probably going to stay on hold for at least a meeting or two. And in the meantime, it looks like the White House, the administration will be doing, pulling all the levers it can and Bessent to try and get the 10 and the 30-year yield down and to, and maybe that's going to be using tariffs. So kind of an interesting little situation here and to see what's going on. Just grab some tea here. Have Earl Grey today. Okay, other interesting news overnight. It's interesting just looking at the dollar because if we look on the back of those lower yields, one would have expected the dollar to have sort of come off a little bit, but actually the dollar's rallied a little bit. But I think, as I say, some of that's technical. It was sold off, fairly hard in the last 2 or 3 days. It hit, as I said, before going back into this big trading range, which starts at around, 107-ish. 107.2. I do believe that's going to be relatively difficult. I think medium term, the US dollar could go down if, a lot of different things change. But at the moment, the threat of tariffs is gone. Okay, great. So the dollar comes back. But the reality is the US economy is still outperforming Europe. It's still outperforming China and most of the rest of the world. And the reality is that the Fed is not cutting particularly compared to, let's say, the BOE we just saw this morning. We'll get onto that in a second. So I think that makes sense for the dollar just to pause here and maybe not rip high, but sort of arrest its fall a little bit. And again, as you guys can see here, sort of a bit of a fib retracement and also coming into a 50-day exponential moving average here, the orange line. So just pushing up a little bit. Talking about a few specific currencies, we had quite interesting news overnight with Japan. The yen really is gathering a lot of strength here. Interesting now against the US dollar, JPY on the technical chart here because it's come back. If you look at this fib, so we're going all the way back down here to 16th of September. If you look at the fib retracement here, we're now at the 61.8 fib retracement, which on the spot is about 151.8, so 151.8, which is also a horizontal level, and it's also the 200-day EMA. So a pretty critical level here. It makes sense again for the US dollar decline to kind of pause here a little bit and maybe to have a little bit of reactive bounce. But what's interesting is that over the last couple of days, we've got a bit more sort of higher sort of wage pressure, high inflation. And last night we got one of the more hawkish members of the BOJ, a gentleman called Mr. Tamura-san, who basically was saying that he thought that inflation is moving upwards. He thought that it makes sense for the 10-year yield in Japan to be up towards maybe 1%. By the end of the year. Sorry, not the 10-year yield, the BOJ's overnight rate, shall we say, because the 10 years are already at 1%. So if we actually look at that, which I think I've got here, let's have a look. Yeah, so this is Japan expectations. So the point is that Tamura was basically pretty hawkish, saying that instead of just doing maybe one more hike this year, the BOJ could do 2 hikes, and that got the market's attention, putting yields higher on the JGBs, the Japanese government bonds, and of course quite a lot of strength in Japan in the Japanese yen. So if we now look, we've got the next meeting 19th of March. The market is pricing in. It's not pricing in a cut, but if you look by the end of the year, you can see that that was at 1. We now have by December, we now have 1.3 hikes. Did I say cuts before? I meant to say hikes. So yeah, hiking by 1.3. So Tamura is basically saying that this number here should maybe go up another couple of basis points, because you can see the effective rate here is just around about 550 basis points. And he was basically saying that he wants that or thinks it should be up to about 100, which would imply 2 more hikes, 1 more than the market had been pricing in. So all that to say, quite a lot of hawkishness coming out of Japan. So we're getting a situation now where most of the global central banks are cutting and easing. The Fed is sort of on hold, and maybe the only one which actually is actively hiking and seems to have an inflationary sort of situation is Japan. And so, of course, what we can see is that against the US dollar, we can see the yen actually really starting to get some downward momentum here. I mean, if it breaks this level, I mean, this is going to be very interesting because we might get a little bit of a bounce. Who knows? Maybe up to something like up here, 153.5. But if it breaks down here, this could easily go back down to let's call it 150 or 149.5. So definitely a lot of strength, and you see that strength in the cross pairs. You see something like Euro JPY, Euro really under quite a lot of pressure here, and it looks as though it's going to retest this low at 156.2, maybe even a bit lower at 155. So I think there's more downside here. You also see the euro against things like the Canadian dollar, some of these cross pairs. Where are we? CAD JPY. You see here that a Canadian dollar falling pretty hard against the JPY. So Japanese yen definitely has some structural strength at this point. The other issue as well is that it's a safe haven. And it also seems to be out of the crosshairs of Trump in terms of tariffs. So there's quite a lot of positivity in favor of the Japanese yen now. You have safe haven status, any drama. It's not really being affected by tariffs that much. And you also have the fact that monetary policy seems to be diverging and a little bit of inflation creeping up there. So the bottom line is that any decent rallies, let's say we're looking at the Canadian dollar, Japanese yen, hoping to get some kind of rally to short. Any kind of rallies on the yen. What I'm saying, any weakness in the yen, depending on the cross, but any weakness in the yen should be bought. So buy the dip on the yen or sell the rally if the cross pair, whatever. So very strong. Other thing to be looking at is that we just had the BOE decision literally 45 minutes ago. So the pound falling on that quite dovish. I'll put it on the future so you can see on the daily chart here. Whoops, hold on, there's the pound. There we go. There's the pound here. So on the daily chart on the futures here, you can see that we did have this fib retracement. You see here up to the 61.8 at about 1.25. Nice level to short, but we did have the BOE. But now that the BOE's come in with a cut, now the cut itself was not unexpected, was fully priced in. So that was fully priced in. What is interesting is that on the Monetary Policy Committee, which is 9 members, it was expected to be 9-0 or 8-1 for a 25 basis point cut. But what we actually just heard was that it was 7-2. So what that means is that two members, which was unexpected, actually voted for a 50 basis point cut, so more dovish, a 50 basis point cut. The other thing as well is that the BOE also revised their outlook for growth lower, so a lower outlook for growth. So basically worried about what's going on in the economy. So all that to say is that the pound taking a bit of a beating. If we put that on a 3-minute chart, this is not going to look good on a 3-minute chart. And so you can see here a big spike down on the 7 o'clock a.m. kind of news here. So again, dovishness there. So again, what we're starting to see here in the world, just stepping back a little bit, is different sort of rates of change for some of the central banks. As I say, we look at the Bank of Japan as the more hawkish one. The Fed seems to be on hold for a little bit, waiting for data and more information about the potential Trump tariffs. And you've got things like the BOE cutting, you've got the ECB cutting, you've got the Bank of Canada. There was even some talk when the tariffs happening of an emergency cut that's for the Bank of Canada. We have the RBA probably cutting for the first time in February. So we have quite a block of affected countries cutting based on the sort of the tariff issue. So what else is going on? We also have today we have a little bit of data, not a huge amount. We just have initial jobless claims. So let's just have a quick look at that. That again is not expected to be such a big deal because the employment situation has been relatively strong, and the initial jobless claims they're saying expected 213, last time 200. Anything below, I would say 250, 260 is a strong labor market. That's the point. And it's been around about 200, 215, 220, 225, 190, 230 for the last year or two. It's a very, very strong numbers here in terms of the labor market. What is going to be very interesting, though, is that tomorrow, of course, we have non-farm payrolls. Now, that in itself will be interesting. What's expected here? What is expected here? We can have a quick look. We'll talk about that later on. 170,000. But what we do get is the annual revisions from the what's it called, the Bureau of Labor Statistics. So the point is that these annual revisions have been going for a long time, last 20, 30 years. It's a normal thing statistically. But I was just reading some commentary this morning, some analysis that it's completely expected that the past labor market details, that the labor market situation will be revised downwards more weekly. Not all of it, but overall it'll be substantially revised downwards. So the question is, and this is referring back to 2024, 2023 numbers. So probably what the market can take away from this was that the labor market over the past 12 to 18 months actually was weaker than reported, So there's two ways of looking at this. One way is to say, hey, markets are forward looking, and this is old news, and the market might have a tiny reaction and move on and say, okay, we sort of knew that, because economists can actually now come up with this data. So I assume that the big banks and trading houses, they've already crunched the numbers and they're fully expecting the downward revisions. On the other hand, can the market sort of take a bit of a pause and say, the economy is not that strong, the labor market actually isn't that strong, and so possibly there will be a little nervousness. Maybe we can see further downward pressure on the yields. Remember, looking at the 10 and the 30-year charts, there's still, 2, 3, 4 basis points to go down. Maybe at the front end of the curve, the SOFRs and the STIRs, the short-term interest rates, might go up in price, down in yield a little bit. So it's going to be interesting to see the market reaction to that, because it's more or less known for those who are looking, but the actual headline number could be quite dramatic. And if you remember, when we last got the annual revisions, I think it was like 800,000 jobs or something. So we could get a big headline number. It could be something like, oh, 1 million jobs lost, or 1 million jobs less created than had been thought, or something like that. Trump will no doubt start pumping out tweets saying how horrible Biden's policy was, et cetera, et cetera, et cetera. Who knows? Maybe even he'll try and put a little pressure on Powell by saying, in this job market, we need to cut interest rates. So that's definitely sort of an extra sort of risk around just the normal non-farm payrolls tomorrow. And that could put maybe a little bit of short-term downward pressure again on the US dollar. Who knows for equities? Again, that's 50-50, because you could argue that a soft economy is not great for equities. But on the other hand, of course, you could say that anything which might cause the Fed to inch closer to their another cut would be beneficial and welcome by the equity market. So kind of interesting to maybe even do some research on that for yourself, guys. See what's expected there in terms of the revisions. There's plenty of articles around in the press talking about that. Anything else we want to look at? I mean, equities grinding a bit higher. Let's have a look overnight. Again, actually, I just got the heat map here for some of the currencies. And so you can see, just in terms of trends, I like to look at this one here. This is the evolution of trends, and you see going back here from the beginning of January. So we've got, basically the last month. You can see here the only sort of really positive trend. You see quite a lot of strength gathering here in the JPY. This is, anything above 3 is quite a strong sort of positive trend. So the JPY is really trending. The others are not doing a huge amount. Euro, USD in general, not a huge amount. The other big trend, of course, is gold, which is really sort of pushing much, much higher. Again, I think some of this is sort of the stockpiling of reserves at the COMEX exchange in New York to kind of front run potential tariffs on precious metals. But the reality is that the gold market, let's have a look this morning. I haven't actually looked yet, to be honest. Let's have a look where gold is. So, I mean, what can you say? This is almost, I don't want to say parabolic, but this is getting very, very overbought. It's a very strong market. The one thing to say, though, which is interesting, is and we'll look on the spot price here. I think if you look at, let's say, a weekly chart, it's interesting. Depends which way you want to look at it in terms of being overbought or not. Because if you look at this sort of channel here on the daily, which I'll put here, this is the spot. So you can see here on the daily, this sort of channel here, it looks as though it's breaking out of that channel. But then if you go on a weekly, suddenly you say, well, in terms of this bull sort of channel, it potentially could head all the way up here just to, get to the top of retest the top of that channel, which would be 2,966. So still another, quite a big chunk on the upside. At this point, it's very difficult to short, because there are good reasons. You have a debasement of the US dollar, you have inflation, which is still a bit sticky, you have geopolitical risk, and you have central banks buying a bunch of gold, and also some asset diversification by asset allocators. So for sure, there are good structural reasons to buy gold. But just from a trading perspective, for those of you who are not in gold, I mean, it's difficult to buy here. One thing but for sure, any kind of significant pullback, this looks like a beautiful level here, 27.86 on spot. Looks like a pretty attractive pullback. So again, at this point, you should just be looking to get maybe cheap call spreads. So we'll look at volatility in a second. And again, looking at some sort of metrics here, you could see that, for sure, is it overbought? In theory, yes, the RSI, but we all know that can go up. But yeah, for sure, it is overbought. But at this point, It was looking like a reversal here, but it just keeps on going up. And the momentum signals, which are these ones here, they're all saying buy signals, and the general momentum signals are still very positive. So, you can't really be shorting this just yet. Although, it did sort of push above on the daily Bollinger Bands. It is overbought. Would it would a reversal surprise? Absolutely not. I mean, it's not a bad risk reward if you want to do a short-term trade on it. But it's pretty brave to be shorting. One thing I would keep an eye on, though, is just the gold GVX, which is the volatility for gold. Let's have a look at that. Just put this back to the white page. And what we can see is that that has had been quite low, but in the last 3 or 4 days, I guess everyone's sort of piling into call spreads, and calls is pushing it a lot higher. So the skew is on the call side is going higher, so pushing the vol high, but still at reasonable levels. If this were to come down to 16 or 15 on the gold vol, and the gold itself came back, that would represent probably quite good value there to maybe buy some call spreads. If the spot price falls back, and if the volatility, the cost of actually buying some options falls back. So keep an eye on GVZ for that. Okay, guys, I might leave it there. Have a quick look at equities. Yeah, equities just trying to sort of push a little bit higher. Again, we have the VIX lower. We have relatively good news in the bond market in terms of lower yields. No crazy Trump headlines for the moment. And an economy which seems to be just chugging along just fine. Thank you very much. And earnings, although they were pitched at quite a low levels, I was just reading this morning that I think so 80 or 90% of companies have beat their earnings relatively comfortably. So relatively good sort of earnings. The only thing which is interesting is that the Mag 7s. This is kind of something to be looking at. Oh, what happened to Mags? That's interesting. What happened to that? Did that just disappear? That's an ETF, unless they've changed their name. Oh, there we go. That was odd. Not sure. Okay, so we see the Mag 7s here not doing that great. We see the equal weight sort of outperforming a little bit. So it's interesting. The breadth of the market is definitely expanding. Okay, but I've talked long enough. So that's it for today. Let's look at the initial jobless claims, and we have some Fed speakers as well. We have Waller speaking today, which is also pretty interesting. But I'll leave it there, guys. Have a great day. Thank you.